Good morning. I will present about important concept in international financial economics. Our group will guide you through what is it, how it affects multinational companies, and the strategies used to manage it. For the introduction, let me start by explaining what translation exposure is. Translation exposure arises when the financial statement of a company foreign subsidiaries need to be converted into the currency of the parent company. This is typically done for financial reporting purpose. What important to note here is that translation exposure does not involve actual cash flow. However, it can still impact reported earning and equity, especially when exchange rate fluctuate. So, even though the company's operation have changed, the number on paper might look different due to currency shifts. This type of exposure occurs at consolidated account level, which can influence how investors perceive the company and affect its market value. To manage this, company use a range of strategy and approach such as different translation methods and hedging techniques, which we'll explain in detail the upcoming slide.
Hello, my name is Nurul Anis binti Omar Ali, and I'm going to present about the translation method. The translation method have four methods. The first one is current rate method. Current rate method is a foreign subsidiary's financial statements into the parent company's reporting currency. The second one is temporal method. Temporal method is a foreign subsidiary's financial statement into the parent company's currency based on how items are measured by historical or current value. The third one is current or non-current method. Current assets and liabilities are translated at the current exchange rate. Non-current assets and liabilities are translated at the historical exchange rate. And the last one is monetary or non-monetary. Monetary items are translated at the current exchange rates, and then non-monetary items are translated at the historical exchange rate.
Hi, my name is Nurul Ismail. For my part is International Accounting Standards. Global Integration and IFRS. IFS enhance comparability and transparency in a global reporting. Aids investor in comparing MNC financial. For IASB and IAS 21, IASB develop IFRS. IAS 21 handles FX rate changes. Guides how to translate foreign operation financial. Different from FASB 52 but same goal, accurate reporting. For example, Cash Centralia Corporation. If a foreign currency depreciates, translated asset value fall more than liabilities, causing a loss. If it appreciates, asset increase more than liability, causing a gain. MNSC must analyze net exposure by currency to assess risk. Centralia net exposure. Canadian dollar 200,000, which is more asset than liabilities. Mexican peso 25 million. For euro 2,101,000, Swiss franc, negative 375,000, more liability than asset. So positive exposure means potential gains if currency strengthen. Negative exposure means potential loss.
Mohammed Sharufazin, and I will present management of transaction. First, I will explain the difference of transaction exposure and transaction exposure. Translation exposure happens when a company needs to convert the financial statements of its foreign subsidiaries into its home currency for reporting purpose. This type of exposure affects only the accounting figures on the financial statements and does not involve actual cash flow. It usually occurs during the process of financial consolidation. For transaction exposure, on the other hand, arises when a company has foreign currency receivables or payables that have not yet been settled. This type of exposure directly affects real cash flow because exchange rate has can cause actual financial gains or losses. It occurs before the transaction is completed and is usually consider more important to manage than translation exposure. Next, I will present hedging translation exposure. For balance sheet hedge, it match foreign currency assets with liabilities in the same currency. Next, it reduce net exposure on the balance sheet. For derivative hedge, it use forward contract to lock in exchange rate, and it can protect against losses but involve some risk.
Hello everyone, so I will continue explain management of translation. Okay, the first one is a balance sheet hedge is used to reduce translation exposure, which happens when a company has assets and liabilities in a foreign currency that do not match. For example, if a company's Spanish subsidiary owns 5 million euro in asset but only 3.2 million euro in liability, the 1.8 million difference is at risk if the euro weakens. To fix this, the company can borrow 1.8 million euro, making asset and liability equal in euros, so any currency changes cancel out on paper. However, this can create a new risk if the company doesn't earn euro. So next is a derivative hedge. A derivative hedge helps manage translation loss by locking in exchange rate using tools like forward contract. If a US company expects to convert 2.1 million euro in the future, it might agree in advance to sell those euro at a fixed rate. If the euro weakens, the contract prevents a drop in value on the financial statement. This keeps the company's equity stable. However, if the euro strengthens instead, the company could lose money on the contract, turning the hedge into a speculative loss. So next I will explain about translation exposure versus operating exposure. Translation exposure is the impact of exchange rate changes on how a company's foreign assets and liabilities appear in a financial report without affecting actual cash. For instance, if the euro drops, a US company euro base asset will seem smaller in dollar, even though the business has not changed. In contrast, operating exposure, also called economic exposure, is the real effect on future cash flow and profit. If a weaker euro makes local competitor more expensive, the company might raise prices and increase profit, showing a real gain, while translation exposure affect how numbers look. Operating exposure affect actual business performance and is more important for long-term success. Now, let's wrap up with the conclusion. Translation exposure affects reported financial performance, but it doesn't impact actual cash flow. This makes it different from transaction exposure, which involve actual cash, and operating exposure, which relates to long-term competitiveness. To manage these, companies often use derivative like forward contract or balance sheet hedges. However, these methods can bring accounting risks such as violation of FASB 133 or other rules. Translation methods like current, temporal, and monetary or non-monetary offer framework to convert financials from abroad. Even though reporting on translation exposure is important, it's more critical to manage exposure from actual translation and operation. Ultimately, current, accurate, and consistent financial reporting build financial strength and stability, and supports effective risk management strategies.